Yeah, Well Health. This came in from Shadow Jedi 007 via YouTube. So
Jedi 007.
yeah, Shadow
Yeah.
Jedi double oh
Wow.
007. That's probably one of your guys' aliases, your burner accounts. Just kidding. It probably isn't. But Well Health Technologies, WELL on the TSX, currently trading at a price of about $3.84, a $924 million market cap. And the company provides omni-channel healthcare services, including primary care and allied health clinic operations, for gastrointestinal, mental disorders, specialized care, diagnostic services, and telehealth services. And the company also operates an electronic medical records platform, billing and revenue cycle management solutions, and cybersecurity protection and patient data privacy solutions. So the last time we included Well on the podcast was back in 2021, and Ryan covered it when it was trading at about $7.50 per share. And since then, we've seen the stock pull back to about $2.56 in late 2022, but the stock did have a stronger 2023, bringing it back to about the $4 range where it trades at today. Now, clients are somewhat familiar with Well, as the company acquired CRH Medical at $5 per share, which was actually a company that we had under coverage with an initial buy in the $4 range. Now, Well has operations in both the US and Canada, with over 530,000 quarterly visits in Canada and over 505,000 in the US. So looking at some of the recent updates, so February 1st of 2024, Well agreed to sell all of the issued and outstanding shares of its subsidiary Intra Health Systems to Healwell AI for a total consideration of approximately $24.2 million. Furthermore, Well also completed the acquisition of Healwell's performing clinical assets in Ontario, and as a result of the transaction, Well became a new control entity of Healwell, holding between 22.7 and 32.7 million shares, or that's about 21% to 27%, depending on whether Well receives payment of the post-closing $5 million in shares. Now, Ryan's going to love the second one. On December 7th of 2023, Well announced that it was selected by the Vancouver Canucks as the official medical services provider, meaning Well is now an integrated part of the Canucks medical team, providing leading-edge diagnostic imaging, sports cardiology, and pain management services. On November 21st of 2023, Well launched their Well AI Inbox Admin, which essentially is an AI-powered system that creates efficient custom workflows to help optimize clinical operations and manage incoming fax documents, which seems, like an old technology, but in Canada especially, the health sector still relies quite heavily on fax. And an initial pilot involving 6 of Well's clinics has begun. And lastly, here on October 26th of 2023, Well acquired, or Well's cybersecurity business unit, Cycura, acquired 2 cybersecurity businesses, Seek Into, as well as Proac. So moving on to the actual financials now. Well's revenue growth has been very strong, driven by acquisitions and organic growth. The most recent financial results were for Q3 of 2023, ended September 30th of 2023, and revenue was up to $204.5 million, which is an increase of 40%. And this was driven by about a 27% increase in patient services revenue in Canada due to organic growth from expanding into Alberta, while on the US side, patient services increased about 52%, which was driven primarily by the Care Plus acquisition acquired in 2023. And although the company has posted strong revenue growth, the company's accounting earnings per share remain negative at a loss of 3 cents per share, while adjusted EBITDA was up, 13% to $28.2 million. But they do have debt on the balance sheet, so the increase in interest expense is somewhat the cause of that. Now, quickly looking at the valuations, the stock trades at about 17.2 times trailing adjusted earnings, about 11.4 times trailing cash flow from operations. So they are cash flowing from operations. I believe over the first 9 months of this year, I believe, this is off the top of my head, I believe it was around 45 to 50 million that they generated. And they also have an EV to EBITDA multiple of approximately 11.7 times. And as I just quoted, the price to adjusted earnings multiple, the company does provide an adjusted net income figure, which was 12.8 million or about 5 cents per share, which represents a decline of 11% year over year. And if we look at the adjustments that are made to net income, nothing looks too peculiar, which they are adjusting out. But I will say, the company's stock-based compensation is certainly an impediment to the company reaching consistent accounting profitability going forward. And looking at the balance sheet as of September 30th, 2023, they had about 45 million in cash, and debt and leases were about 404 million, providing a net debt and leases position of about 359 million and a net debt to EBITDA multiple of about 3.3 times. And I believe most of their debt is floating rate, but they do have a 3-year interest rate swap, which they entered into last year, which they're locking in about 50 million of their debt with a fixed rate of around 4.7%. So not only has the company been taking on debt to fund their expansion, they have also issued shares quite aggressively, as shown in the chart in my slideshow, with the company now up to just under 250 million shares outstanding. And, I must remind our listeners that an acquisition growth strategy funded through issuing shares can be successful, but it is a much harder path to growing cash flow per share than simply recycling excess cash flow into acquisitions. Now, looking at the company's Q4 2023 update, the company announced that they expect positive EPS on both an adjusted and unadjusted basis in Q4, and they anticipate record quarterly revenue once again. And for 2023, back in November, upgraded its guidance to between 755 to 765 million in revenue for fiscal year 2023, and they are guiding for fiscal year 2024 for revenue to be about 900 million, with what they're calling sustained gains in adjusted EBITDA and cash flow. So to conclude, Well has shown great revenue growth over the past few years, with revenue of just 32.8 million in 2019 and is now up to over 700 million expected for fiscal year 2023 and 900 million expected in fiscal year 2024, as I said. The company's astonishing growth has been primarily driven by acquisitions funded through share issuances and debt. And overall, it is good to see that the company is producing cash flow, which will help the company pay down its debt, which I would say is on the high side currently. And hopefully this cash flow will reduce Well's reliance on issuing shares. So given the strong acquisition and organic growth, the valuation of 17 times adjusted earnings and around 11 times price to cash flow and about 11.5 times EV to EBITDA, the business looks reasonable given its recent growth, and management's talking about about 30% organic growth in Canada and the US from just growth in patient visits. However, this sounds good, but, it would be great to speak with management to get a better gauge on the trend line organic growth rate to help determine how reasonable those multiples really are, considering this growth that we're expecting. So all in all, the company still has work to further progress into accounting earnings, reduce its debt load, and reduce its cadence of issuing shares. But if the company can begin to achieve consistent accounting and adjusted profitability and use its internally generated cash flow to bolster growth going forward, I think that there could potentially be an inflection point in the business in the future. But that is in the future, as it has yet to be determined right now. And right now, it is a stock which we will just monitor. And like Ryan said back in 2021, still one which we are not recommending to our clients.
Yeah, I mean, it's interesting. I mean, it's not a bad business, certainly.
No.
It's admirable revenue growth. The consolidation that they've done is significant. Obviously, we'd like to see a better per share cash flow growth. They look to be targeting that 30% number in terms of organic growth sounds very high.
Yeah.
And historically has not been near there for the business and like some of the businesses that they bought. So we'll see if they can come close to that. We'll likely reach out and talk to management and go over that number to see if that's something that they really feel is realistic to do, and how sustainable that is over the next 3 to 5 to 10 years. Really, is what we'd like to see. We earlier in the year, we this past year in the fall, we recommended a health software company, health related software company, and it traded about 10 times free cash flow. The difference, there was that, the organic growth rate was, anywhere in the range of 15%. Plus, you had the potential for acquisitions, but you had a net cash position in the business and no debt. So that was, the difference. What is, well, share price done since then? Well, it certainly hasn't done. I mean, that the other company's up 90% since November.
Yeah.
I, it's not surprising to me that, since September, the share price is down, when you're in a significant debt position. They're trying to deleverage the business. These are better numbers that we saw out in January, and it does pique my interest if they can continue that. But certainly it would be harder to continue to grow by issuing debt at this point. At the multiple you were talking about to debt, it was 3.3,
I believe, around there.
Yeah, I wouldn't like to see them go significantly above that. And then they think their share price is undervalued. Do you really want to issue equity here? So those, again, you get in this situation, we have significant debt and the market is saying, interest rates are up. Your cost of carrying that debt has come higher. We don't want, we're not rewarding you in the market with a higher share price. So it's your situation. How do you grow going forward when most of it was from acquisition? They're talking up organic growth. Potentially that is an angle. For us, if we got a business that can grow 20+% organically, that's tremendous. So we'll talk to management and see how far we get in terms of their cadence going forward on organic growth.
Yeah. One critique on my own analysis here, like, in what you had, is like I should have showed up, just like the cash flow per share over time, just to show, which I don't have. So, bad, Brennan. But that is something that, if someone is actually wanting to invest in the company, you should be looking at, the cash flow per share growth over the long run.